Imagine two houses in Tarrant County. Like, they are the exact same size, roughly the same square footage, built around the exact same time. Maybe they even have that same outdated beige tile in the guest bathroom.
Oh, yeah, the classic early 2000s tile.
Exactly. Yet you look at the localized data we're unpacking today, and one of those houses is going to sell in 36 days for well over asking price.
Right.
And the other one, it's going to sit on the market, take like a 14% price cut, and just languish for months. I mean, how does that happen?
It really just shatters that whole illusion of a monolithic real estate market, you know?
Yeah, totally. How can a single housing market be completely flat and like skyrocketing at the exact same time?
Well, we are so conditioned by national financial media to think of housing as this giant unified dial that just turns up or down for everyone all at once.
Right, like it's one big thermostat.
Exactly. But when you actually get into the granular data, you realize that narrative is fundamentally broken.
Yeah.
I mean, we aren't looking at one housing market right now.
We're looking at dozens of them.
Hundreds, really. We are looking at fractured, hyper-segmented microeconomies operating with entirely different rules. And they vary wildly, not just from city to city, but literally from one ZIP code to the one directly across the highway.
And that is exactly what we are here to untangle today. So, welcome to this deep dive. It is late May 2026.
Memorial Day weekend is almost here.
It is literally knocking on our door. Schools across Texas are letting out, the pools are opening up, and we're basically standing on the precipice of the traditional summer real estate rush.
The spring sprint is over, and the summer rush is on.
Right. So our mission today for you, the listener, is to make sense of a towering stack of raw, highly localized real estate data. We are focusing intensely on Tarrant County, Texas today.
Which is a fascinating case study right now.
It really is. We are pulling directly from the April 2026 and Q1 2026 reporting by Entry ICE. That's the North Texas Real Estate Information Systems. And we're cross-referencing all of that with the latest analysis out of Texas A&M's Real Estate Research Center. Plus, we're layering in current localized mortgage data.
And honestly, the timing on this deep dive couldn't be better.
How so?
Because the transition from the spring market into the summer rush is usually when the market sort of tips its hand. It shows us whether the momentum we saw in Q1 was just a seasonal mirage or an actual structural trend.
Right. And right now, as we analyze this specific data, Tarrant County is behaving in a way that just defies conventional economic logic.
Completely defies it.
Yeah, it's presenting some profound traps and some massive leverage points, frankly, for anyone transacting this summer. So whether you are getting ready to list your place in Arlington or aggressively hunting for a custom home lot, or you're simply a data nerd trying to figure out where the broader economy is actually headed, we're going to arm you with the reality behind the clickbait.
Because the clickbait is intense right now.
Oh, it's everywhere. Okay, let's unpack this. Before we zoom in on the borders of Tarrant County specifically, I want to establish the atmospheric pressure, the macro backdrop that's driving consumer sentiment.
That's a good place to start. The national numbers always set the mood.
Right, and the national numbers right now are giving me whiplash. I was looking at the latest drop from the National Association of Realtors, and U.S. existing home sales unexpectedly jumped 1.7% month over month.
Yeah, hitting a seasonally adjusted annual rate of over 4 million.
Exactly, 4.09 million. On top of that, national inventory actually grew. It's up 4.9% year over year to roughly 1.29 million units.
Which translates to about a 3.8-month supply nationally.
Right, and despite the fact that supply is expanding, national home prices just climbed again, up 0.3% year over year to a median of $398,000.
Which is the 32nd consecutive month of year-over-year national price increases.
32 months.
Almost 3 solid years of relentless appreciation, even if it is decelerating a bit. The national data sets that psychological tone. Buyers and sellers absorb those headlines, and it dictates their baseline confidence before they even look at their own neighborhood.
Right, but then you pan over to our own backyard, and the broader North Texas regional data totally rebels against that national script, like completely.
Oh yeah. North Texas is on a different planet right now.
Across North Texas as a whole, inventory didn't grow. It shrank, down 2.8% to just over 44,000 units. And prices didn't go up. The overall North Texas median sales price actually dropped 4%, down to $360,000.
So we have this massive inversion.
Yeah.
The national machinery is generating more inventory and pushing prices upward, while the broader North Texas region is tightening its inventory and pulling prices downward. I mean, it's a complete structural divergence.
I have a serious bone to pick with that national narrative, though. I really want to challenge the logic of that 1.7% sales jump nationally.
Let's hear it.
If national mortgage rates are still stubbornly hanging out near 6%, which, let's be honest, feels light years away from the 3% pandemic rates, who are these people buying?
That's the million-dollar question.
Like, where is this sudden burst of national buyer activity coming from when capital is still this historically expensive? It makes no sense to me.
Well, I don't think it's a mystery of capital, honestly. I think it's a capitulation of psychology.
What do you mean by that?
We are firmly entrenched in what everyone calls the new normal. For the better part of 2 years, a massive cohort of potential buyers just parked themselves on the sidelines.
Just waiting it out.
Right. They were operating under the assumption that 6% rates were an aberration, right? Like a temporary fever that the Federal Reserve would eventually break, returning us to the promised land of 3 or 4%.
Which didn't happen.
Exactly. As we see here in late May 2026, the realization has crystallized for these buyers. Those rates are gone. The fever broke, but the patient woke up in a permanently higher rate environment.
So the lock-in effect is finally eroding. Like, people are just giving up and moving.
It has to erode structurally. You often hear economists talk about the 3 Ds of real estate: death, divorce, and diapers.
Ah, right, life event.
Yes. Life events do not care what the 10-year Treasury yield is doing today. You have millennials who delayed homeownership and are now having their second child in a cramped 2-bedroom apartment.
They physically need more space.
Exactly. You have boomers who physically need to downsize to single-story living because of mobility issues.
Yeah.
You have corporate relocations. The pent-up organic demand generated by human demographics simply overwhelmed the financial hesitancy. People capitulated to the 6% reality because they literally had to get on with their lives.
I buy that for the organic life events, absolutely. But what about the sheer affordability aspect?
It's tight. Very tight.
Right, because if rates are double what they were in 2021 and prices are up for the 32nd consecutive month nationally, the monthly payment on that $398,000 median home is astronomically higher. Are wages actually supporting this? Or are buyers just over-leveraging themselves to the absolute brink?
Well, that is the dark underbelly of the new normal. It's not necessarily that housing is comfortably affordable for the average W-2 earner.
So how are they qualifying?
It's that buyers have adjusted their consumption in other areas of their lives to absorb the housing cost. Or, and this is the big one, they're utilizing massive equity transfers.
Like family money.
Think about the baby boomers. We are in the middle of the largest generational wealth transfer in human history. A lot of these national transactions aren't young couples scraping together a 5% down payment from their salaries.
They're getting help.
Substantial help. They are young couples using a $100,000 gift from their parents' equity to offset the high interest rate. Or they are repeat buyers rolling over massive equity from a previous home sale. The reliance on pristine wage-to-debt ratios is masking the fact that equity, not pure income, is driving a huge swath of this national volume.
That is wild to think about. And that structural reliance on existing equity rather than pure income mobility makes the North Texas contraction we talked about even more interesting.
It really does. Because North Texas operates a bit differently.
Right. So the broader North Texas region is hovering around a 4.5-month supply, which feels like it's inching toward a balanced market, right?
Taking closer, yeah. A balanced market is typically 4 to 6 months.
But Tarrant County specifically is not playing along with the rest of North Texas. If North Texas is moving toward balance, Tarrant County feels like it is aggressively resisting it.
Tarrant is highly insular right now. It is operating with a distinct leanness that really sets it apart from Dallas, Cullen, or Denton counties.
So let's look at the actual inventory. Let's dig into the Entrace April 2026 drop. At the end of April, there were exactly 6,372 homes active on the market in Tarrant County.
Which sounds like a lot, but historically it's not.
Not at all. That is a 5.2% decrease from April 2025. And we know that translates to a 3.5-month supply. So we're well below that 4 to 6 month threshold of a balanced market. Tarrant is officially still a seller's market.
Very much so.
But what bothers me about this supply metric is the lack of new construction backfilling the deficit. Why is Tarrant's inventory continuing to shrink when builders have had years to catch up from the pandemic delays?
You're hitting on a critical bottleneck there. It's not just that existing homeowners are clinging to their 3% mortgages, though. I mean, that lock-in effect is still potent.
Sure, nobody wants to trade a 3% rate for a 6% rate if they don't have to.
Exactly. But it's also the cost of development. If you look at the raw materials, the labor shortages in the trades that still haven't fully resolved since 2020.
finding a good plumber or electrician is still a nightmare.
Right. And then add in the incredibly high cost of acquisition and development loans for builders right now. Their margins are razor thin on entry-level homes.
So they just aren't building them.
Builders in Tarrant County are highly hesitant to spec build large swaths of affordable median-price housing. It's too risky. Instead, they're focusing on higher-margin luxury builds, or they're aggressively spending their capital to buy down mortgage rates on their existing inventory to move it, rather than flooding the market with new starts.
Which artificially constricts the supply even further.
Absolutely.
And when you have constricted supply, you usually get a violent reaction in demand. Let's look at the velocity in Tarrant. Single-family closed transactions actually jumped 5% in April, hitting 1,951 sales. And the total county closed sales, if we include condos and townhomes, were up 2%.
But the year-to-date data provides a really necessary counterweight to that April jump, though.
Right, because year-to-date sales are actually down 0.5%.
Exactly. So we had a deeply anemic Q1. The first few months of 2026 were sluggish, buyers were hesitant, and then April was just a rocket ship.
The days on market metric completely confirms this. In Q1, homes were sitting for about 61 days. By the end of April, that compressed violently down to just 48 days.
That's a massive shift in market speed.
It reminds me of the pressure differential in a pipeline. Q1 was this slow trickle, cars coasting on I-35 on a Sunday morning, buyers taking their time, negotiating.
Stopping at Buc-ee's.
Exactly, pulling over at Buc-ee's. But then the spring buying season unlocked, the pressure spiked, and suddenly everyone is hitting the gas. Homes are vanishing almost 2 weeks faster than they were in February. The window to merge into a lane or buy a house is closing fast.
It is, but I would caution against interpreting that compression as some sort of unlimited runway of demand.
What do you mean? You think they're running out of steam?
I do. Look at the pending sales. The closed sales in April jumped 5%, right? But those represent deals that were likely negotiated in late February or March. The pending sales for April, the contracts actually signed during that 30-day window, those dipped 3% year over year.
I noticed that. But the year-to-date pending sales are essentially perfectly flat, sitting at 7,655 contracts, up a tiny 0.1%. I'm inclined to view that 3% dip in April as statistical noise. Maybe just a function of the Easter holiday shifting or a couple of rainy weekends depressing foot traffic. Do you really see it as a leading indicator of a summer slump?
I see it as exhaustion. The buyer pool in Tarrant County is highly motivated, but they're also incredibly rate fatigued and price sensitive.
Rate fatigued. I like that term.
It's real. When inventory shrank and the days on market compressed down to 48 days, the competitive environment heated up fast. Buyers who engaged in March and early April likely experienced multiple offer situations again for the first time in a while.
Oh, the dreaded bidding wars.
Right. Some won those wars, which drove up the closed sales metric, but many lost. And instead of aggressively bidding on the next house with that same manic energy from 2021, they just stepped back. That 3% dip in pending contracts suggests that buyers will engage when they see value, but the minute the market feels irrationally competitive, they pause.
They're not acting with blind panic anymore.
Exactly. They have boundaries now. They are fiercely protective of their capital. They will compete, but they absolutely will not overpay.
Which creates a fascinating economic paradox. If supply is shrinking down 5.2% and velocity is increasing, with days on market dropping from 61 to 48 days, traditional supply and demand models dictate that prices should be escalating rapidly.
Basic economics, yeah. The resource is scarcer and moving faster.
Exactly. But the pricing data in Tarrant County is telling a totally different, highly bifurcated story. It's wild.
The pricing paradox is arguably the most important dynamic for our listeners to grasp today, because it completely changes how you strategize your transaction this summer.
Let's look at the median first. The median sales price for all property types in Tarrant County in April 2026 was $350,000.
Which is?
Dead flat compared to April 2025. 0% change.
Unbelievable.
If we isolate just single-family homes, the April median was $355,000, up a barely perceptible 1%. And the year-to-date county median is basically frozen at roughly $347,000.
So the median is the anchor of the workforce housing market, right? It represents the dead center of the transaction volume. The fact that it is completely flat despite tightening inventory confirms what we just discussed. Total buyer exhaustion.
They've hit a wall.
A brick wall. The buyer purchasing a $350,000 home in Tarrant County is heavily reliant on traditional financing. They are highly sensitive to that 6% interest rate. Their debt-to-income ratio simply cannot stretch to accommodate a bidding war.
The bank won't let them, even if they wanted to.
Exactly. When prices push against that ceiling, demand just evaporates. The market has hit a hard affordability wall at the median level.
But the average sales price is completely detached from that wall. It's doing its own thing.
The average is telling a totally different story.
The average sales price in April jumped to $460,632. That's an increase of 1.5%. And the year-to-date average is up 2.8% to nearly $442,000.
That divergence, a flat median and a rising average, is the mathematical signature of a K-shaped real estate market.
A K-shaped market. Okay, break that down for me.
Basically, the upper echelon of the market is pulling the entire mean upward, while the middle-class segment remains completely stagnant. The two segments are moving in opposite directions, like the arms of the letter K.
Let's contextualize this with the city-level data, because I think it paints such a vivid picture of this class divide. Look at the core of the workforce housing. Fort Worth proper has a median price of $320,000, and those homes are moving in 55 days. Arlington is at $333,450, moving in 46 days.
This is the flat line.
This is the segment constrained by W-2 incomes and 6% mortgages.
And then you look at the wealth centers.
Exactly. We pan over to Grapevine, and their median price is $597,000 in those homes. They're moving in just 36 days.
Which is incredibly fast for that price point.
They're almost $600 K, and they are selling a full 10 days faster than the affordable homes in Arlington. It's crazy. Keller is sitting at a median of $645,000. And Southlake. Southlake is in a different stratosphere entirely with a median of $1.39 million.
It's a completely different world.
So why is a $600,000 home in Grapevine moving faster than a $300,000 home in Fort Worth?
Because the buyer profile in Grapevine and Southlake is fundamentally insulated from the macroeconomic headwinds that are paralyzing the Fort Worth buyer.
They don't care about the 6% rate.
They really don't. The luxury and upper-tier markets are not driven by first-time buyers trying to desperately qualify for an FHA loan. They're driven by massive equity transfers. We are seeing a continued influx of high-net-worth individuals relocating to Tarrant County from higher cost-of-living areas.
Like California and New York.
California, New York, Illinois.
Yeah.
A buyer selling a modest, 1,500-square-foot home in San Jose for $2.5 million can drop $1.39 million in cash on a sprawling estate in Southlake and literally not even glance at the current mortgage rates. The cost of borrowing is completely irrelevant when you are deploying cash.
Or, if they aren't paying pure cash, they're using portfolio loans backed by their stock assets, right? Which have completely different underwriting structures than a conventional 30-year fixed mortgage.
Precisely. They have access to sophisticated financial instruments that the median buyer just doesn't have. Even local move-up buyers in that tier, people moving from Keller to Southlake, are rolling over hundreds of thousands of dollars in equity gained over the last decade. The high-end market is transacting on accumulated wealth, not current income.
Which explains everything.
That is exactly why it is accelerating and moving in 36 days, while the middle-class market is stagnant at 55 days.
So if I'm a listener entering the market this summer, this divergence is my entire playbook.
It'd have to be.
If I'm selling a $350,000 house in Arlington, I cannot price it like it's 2021. If I overprice by even $15,000, I will hit that affordability wall, buyers won't even tour it, and I'll be sitting for 60 days waiting for a price cut.
You'll be chasing the market down.
But if I'm listing a premium, heavily updated home in Grapevine, I might actually have room to push the envelope because my target demographic isn't sweating a half-point fluctuation in the mortgage rate.
Exactly. The strategy has to perfectly match the specific microeconomy of the price bracket you are in. A rising tide is no longer lifting all boats. Some boats are anchored to the ocean floor by interest rates, and others are happily floating on a wave of cash.
Floating on a wave of cash. I love that. Speaking of pricing strategy, though, I want to bridge the gap between the theoretical list price you see on Zillow and what sellers are actually extracting from these deals at the close-it table.
The real numbers.
Right. Zillow estimates and listing prices are great for neighborhood gossip, but the percent of original list price received metric, that is the ultimate reality check.
It strips away all the marketing fluff and shows us the raw negotiation leverage, who is actually winning at the table.
In April 2026, sellers in Tarrant County received 96.4% of their original list price. Year-to-date, it's slightly softer at 95.5%. Now, historically speaking, capturing 96.4% of your asking price is a pretty strong position.
It's very healthy.
It's not the 105% bidding war era of the pandemic, but it's not a bloodbath either.
Right? It indicates a very functional, rational market.
Mm.
Buyers and sellers are finding common ground.
But let's actually run the math on what that 3.6% gap means in real dollars, because it's significant for a normal family. If you list your home right at that Tarrant County median of $350,000 and you close at 96.4%, the final transaction value is roughly $337,400.
Which means
You are leaving $12,600 on the table between the day you list and the day you hand over the keys.
and the composition of that $12,600 is where the real nuance of the 2026 market lies. It's not as simple as a price cut.
I want to dig into that composition because my instinct is that buyers are walking through these $350,000 houses, finding out the HVAC system is 12 years old, the roof has some hail damage, and they are just ruthlessly negotiating $12,000 off the purchase price after the inspection. Is that 3.6% gap just deferred maintenance coming home to roost?
Some of it certainly is. I mean, buyers are far less forgiving of condition issues today than they were a few years ago.
Yeah.
You can't just put a house with a bad foundation on the market and expect 10 offers anymore.
Definitely not.
But the data suggests that a massive, perhaps even dominant portion of that gap is not a reduction in the sales price itself, but rather structural seller concessions.
Let's use an analogy here because I think this is crucial. I liken this to buying a truck at a dealership. You walk onto the lot, and there is a $60,000 sticker price on the windshield. The dealership adamantly refuses to lower that sticker price to $55,000 because it ruins the valuation comps for the rest of their inventory.
They want the public to see $60,000.
Exactly. But to get you to sign the paperwork today, they will happily give you a $5,000 rebate applied directly to your financing. The sticker price stays the same, but the dealership subsidizes your cost of capital. That is exactly what sellers are doing right now, isn't it?
That is a perfect encapsulation of the current market. Sellers are incredibly protective of their home's perceived value. They want to tell their neighbors they sold for $350,000. They want the public tax record to show $350,000. So they hold the line on the contract price.
But the buyer pushes back.
Right, the buyer comes back and says, look, I love the house at $350,000, but at a 6% mortgage rate, my monthly payment is $300 higher than I can comfortably afford. I need help.
Mm-hmm.
So the seller agrees to keep the price at $350,000, but writes a check at closing for $12,000 to cover the buyer's closing costs.
Or, more strategically, to fund a mortgage rate buy-down.
Yes. The rate buy-down is the defining feature of the median market right now.
This is where the macroeconomy violently collides with the kitchen table budget. We cannot talk about a seller coughing up $12,000 without doing a deep dive into the cost of borrowing money right now.
The mortgage rates are the invisible gravity governing the entire Tarrant County median market. Everything revolves around them.
So let's look at the localized DFW mortgage data for April 2026. A conventional fixed 30-year mortgage is sitting at roughly 5.99%, carrying an APR of 6.16% once you bake in the fees.
Right around that 6% mark.
The conventional fixed 15-year is averaging 5.38%. If you're looking at FHA products, which heavily support that $350 median tier we've been discussing, a fixed 30-year is 5.88%, and the FHA 15-year is 5.25%.
They are sticky. They have been oscillating in this high 5, low 6 band for quite some time now. And to really understand why they are stuck there, we have to talk about the 10-year Treasury yield.
I see the 10-year Treasury referenced constantly in financial media, but it's usually just thrown around as Wall Street jargon. I want to demystify this for you, the listener. Why does a bond yield in New York dictate what a family in Arlington pays for their house? Walk me through the actual mechanism.
It comes down to how mortgages are actually funded. When a local bank writes a mortgage for that family in Arlington, they don't usually keep that loan on their books for 30 years and just collect the interest.
No, they want their money back so they can write another loan.
Exactly. So they package it with thousands of other mortgages into what's called a mortgage-backed security, or MBS, and sell it to global investors on the secondary market.
To free up their capital.
Exactly. Now, if you are a global investor, you have choices on where to park your money. You can buy the safest asset on earth, which is the 10-year U.S. Treasury bond, fully backed by the federal government. Or you can buy a mortgage-backed security, which carries slightly more risk because a homeowner might default, or they might refinance early.
And investors demand a premium for taking on risk.
Right. To convince that investor to buy the MBS instead of the Treasury bond, the MBS has to offer a higher return. Historically, that spread between the 10-year Treasury and the 30-year mortgage rate is roughly 1.5 to 2 percentage points.
Okay, so if the 10-year Treasury yield is sitting at 4.2% right now, the mortgage market inherently has to be hovering around 6% just to remain competitive for those global investors.
That is the floor. Unless the 10-year Treasury yield significantly drops, which requires the broader economy to cool down, inflation to thoroughly retreat, and the Federal Reserve to signal long-term rate cuts, mortgage lenders physically cannot offer rates in the 4s or low 5s. They would be selling those MBS packages at a massive loss. The 10-year Treasury is the concrete foundation upon which mortgage rates are built.
But the forecast from Texas A&M's Real Estate Research Center is actually projecting a shift. They are projecting that, assuming inflation stays near the Fed's target, mortgage rates will likely experience a gradual easing, dropping down into the 5.0 to 5.6% range by late 2026 or early 2027.
That is the consensus macroeconomic forecast, yes. Easing, but not plummeting back to pandemic lows.
So let me aggressively play devil's advocate here.
Go for it.
I am a listener. I am currently renting a nice apartment in Fort Worth. I have my down payment saved up. I'm looking at a $350,000 house today at 6%. But I hear Texas A&M predicting rates could hit 5.2% by Thanksgiving. Why in the world would I buy today?
Oh, this is the classic trap.
Right. Shouldn't I just renew my lease for 6 months, sit on my hands, and buy when the debt is cheaper? Explain to me why waiting is a bad mathematical decision.
Because you're calculating the cost of debt without calculating the cost of the asset. You're operating under the assumption that the $350,000 house will still be $350,000 in November.
And you're saying it won't be?
It absolutely will not be. This is the ultimate waiting game fallacy, and it traps buyers every single cycle.
Let's do the math on it. Challenge my premise. Show me why I'm wrong.
Gladly. Right now, at 6%, the market is stable. You have 48 days of inventory. You have sellers willing to negotiate that $12,600 concession we just talked about. The environment is rational. But human behavior is herd behavior. If you were sitting in your apartment waiting for 5.2%, who else is waiting?
Well, literally every other renter in Tarrant County.
Exactly. The minute rates cross that psychological threshold into the low 5s, the dam breaks. Every buyer who is sidelined by affordability jumps back into the market on the exact same weekend. You instantly transition from a rational market to a frenzied, multiple offer bloodbath.
Like 2021 all over again.
Inventory evaporates. That stable $350,000 median price doesn't stay flat. The sheer force of demand pushes it to $375,000 or $385,000 practically overnight.
Okay, so let's run those numbers. Let's say I wait and I get my magical 5.2% rate, but I have to pay $375,000 for the house because of a bidding war. A $375,000 loan at 5.2% gives me a principal and interest payment of roughly $2,059 a month.
Now run the scenario if you buy today.
If I bought today, I lock in the flat $350,000 purchase price. A $350,000 loan at 6% gives me a principal and interest payment of roughly $2,098 a month.
So you waited 6 months. You completely lost the opportunity to negotiate a seller concession because you're now in a bidding war. You had to take on $25,000 more in principal debt. Your down payment requirement increased. Your property taxes will be assessed at a higher value. And you saved less than $40 a month on your mortgage payment.
Wow. When you break it down like that, it's brutal. The $40 monthly savings takes over 50 years to recoup the extra $25,000 in purchase price. The math violently punishes the person who waits for the headline rate drop.
The smart money in Tarrant County is doing the exact opposite.
What are they doing?
They are using the current inventory stabilization to negotiate. They find the $350,000 house today. They use the lack of buyer frenzy to demand that $12,600 seller concession. And instead of using that money to just cover title fees, they deploy it into a permanent rate buy-down with their lender.
Talk about that mechanic, because this is vital for the listener. How does a permanent buy-down work versus a temporary 2-1 buy-down? We hear both terms thrown around constantly.
Okay, so a temporary 2-1 buy-down takes the seller's concession and uses it to subsidize your rate for just the first 2 years. So if the market rate is 6%, your rate is essentially 4% year 1, 5% year 2, and then it reverts to the standard 6% for the remaining 28 years.
Got it.
It's a great tool if you expect your income to rise significantly or if you're banking on refinancing in the near future. But a permanent buy-down uses that seller cash to purchase discount points from the lender up front, permanently lowering your rate for the life of the loan. You might use that $12,000 concession to buy your rate down from 6% to 5.25% permanently.
That is the ultimate leverage.
It really is.
You secure the asset at today's flat, uninflated price, you avoid the forthcoming bidding wars, but you use the seller's equity to manufacture the lower interest rate you wanted anyway. You are essentially time traveling to November's projected rates while paying May's stable prices.
It requires an aggressive, highly strategic approach, but it is mathematically the most sound way to navigate this specific median market right now.
I love that. It turns a macro disadvantage into a micro leverage point. Now, we have spent a lot of time dissecting the single-family suburban market with subdivisions in Arlington and Keller, but Tarrant County is vast. I want to pivot and explore what I call the Wild West of the real estate data.
The land and farm data.
Yes. We need to look at farm, ranch, and land sales, and then play a little game of ZIP code roulette to prove just how insane this microsegmentation can get.
The land data provides a phenomenal contrast to everything we just discussed. If the single-family market is a tactical chess match, the land market right now is an absolute staring contest.
The numbers are staggering. In April 2026, there were exactly 0 farm sales recorded in Tarrant County through the MLS. Not a single working farm changed hands.
Which highlights extreme scarcity. Tarrant County is highly developed. Finding viable, large-scale agricultural land that hasn't already been acquired by developers is incredibly rare.
And expensive.
Very. Furthermore, the cost of capital for massive agricultural loans requires substantial cash reserves. It's a very illiquid asset class right now.
On the pure land side, vacant lots and acreage, there were 32 closed sales in April. But look at the divergence in the pricing metrics here. The average land price came in at $279,734, which is actually down 6% from last year. However, the median land price was $150,000, which is up a massive 15% year over year.
Another perfect example of why averages can be so deceiving.
Right.
The median is surging 15% while the average is dropping. This tells us exactly what is moving and what is sitting. The $150,000 median indicates that smaller, more affordable parcels, likely residential-sized lots intended for single custom builds, are highly sought after.
People who are frustrated by the lack of existing inventory are just deciding to buy a small lot and build their own home.
Exactly. That demand is driving up the median price of those small parcels.
But the large multi-million-dollar sprawling tracts of acreage...
They are dead in the water. Those massive, expensive parcels are sitting completely untouched. Because they aren't selling, their high price tags are no longer pulling the overall average up, which results in that 6% drop in the average price metric.
The timeline metrics for land are just absurd compared to residential. The days on market for land right now is 229 days.
Nearly 8 months. Compare that to the 48 days for a single-family home.
And the month supply for land is sitting at a towering 15.8 months. If we consider 4 to 6 months balanced, 15.8 months is a catastrophic oversupply.
It is the deepest buyer's market in the entire county. If you are a listener looking to acquire land in Tarrant County, you hold absolutely every card in the deck. You have ultimate leverage.
You can just wait them out.
You are negotiating with sellers who have been staring at an active listing for over half a year with zero activity. You can take your time, conduct exhaustive feasibility studies, and negotiate fiercely on price.
That divergence between a 3.5-month supply for houses and a 15.8-month supply for land is wild. But you don't even have to change asset classes to see that kind of volatility. You literally just have to change exits on the freeway.
This is where it gets fun.
I pulled some Q1 2026 localized data to highlight how hyper-local this gets. Let's look at downtown Fort Worth, ZIP code 76102. In Q1, the median price there fell off a cliff. It plummeted 23.9% year over year, dropping down to $352,000.
A 24% drop in urban core pricing is a massive structural correction. We are seeing the delayed contagion of the commercial real estate sector bleeding directly into residential condos.
Break that contagion down for me. How does one affect the other?
Well, downtown living is predicated entirely on proximity to amenities, right? Offices, high-end dining, entertainment.
Walkability factor.
Exactly. With the permanent scarring of the commercial office sector due to entrenched remote and hybrid work models, these massive office towers are sitting underutilized. When the daytime worker population vanishes, the ground floor retail and restaurant ecosystem slowly collapses.
The coffee shops close, lunch spots close.
Right. Suddenly, the value proposition of owning a high HOA condo in 76102 is severely diminished. You are paying a massive premium for a vibrant downtown lifestyle that simply isn't as vibrant as it was in 2019. Buyers are recalibrating the value of that high-density living, and it is forcing massive price corrections.
That is fascinating. The demise of the office cubicle directly tanks the condo market 3 blocks away. Now, let's drive just a few miles north to ZIP code 76164, the historic north side of Fort Worth. The median price there is incredibly low, sitting at $156,000. But if you look at the underlying health of those transactions, sellers in 76164 are getting absolutely hammered at the closing table. They're only receiving 86.2% of their original list price.
Taking a near 14% haircut on your list price is a glaring red flag for that specific micromarket.
Why is it happening?
In a lower price tier like $156,000, you are often dealing with older, perhaps neglected housing stock. Buyers in that bracket are usually utilizing FHA or VA loans, which have incredibly strict mandatory appraisal and condition requirements.
They won't just lend on anything.
No, they won't. If a house in 76164 has peeling lead paint, an end-of-life roof, or foundation issues, the FHA appraiser will simply refuse to fund the loan until it's fixed. Because the sellers in that price bracket rarely have the liquid cash to do a $15,000 roof replacement before closing, they are forced to slash the purchase price drastically to keep the deal alive.
So it's a condition-driven price collapse, essentially.
Well, it's not that the land is worthless. It's that the deferred maintenance is pricing it out of traditional financing.
Which is a heartbreaking position for a seller trying to extract equity. But then we drive over to the east side of Fort Worth, ZIP code 76105. Over there, the median price actually jumped 11.6% year over year, landing at $254,000.
So think about that. In the exact same city, in the exact same quarter, you have the downtown core imploding by 24%, the north side taking 14% condition-based haircuts, and the east side surging by nearly 12%.
Why is the east side surging like that?
Displacement and gentrification. As the median price of Arlington pushes toward $340K, and Central Fort Worth stabilizes around $320K, first-time home buyers and institutional investors are being squeezed out. They operate on a strategy of drive until you qualify.
Just keep going out until the math works.
Right. They look at the map and find the closest geographically convenient area where prices are still in the mid-$200. That happens to be 76105 right now. That influx of displaced buyer demand combined with investors flipping properties creates a localized boom, rapidly driving up the median price in a previously overlooked neighborhood.
It completely validates why reading a national headline in the Wall Street Journal about Texas real estate prices falling is practically useless if you are trying to make a decision about your own net worth. The macro data might tell you it's a drought, but on your specific block in East Fort Worth, it's a torrential downpour of equity.
Relying on national data to make a local real estate decision is like checking the national average temperature to decide if you need an umbrella today. It's statistically accurate, maybe, but practically useless.
So we need to synthesize this. We need to tie off these threads for our listener. Imagine they are heading to a Memorial Day BBQ this weekend, standing around the grill, and someone starts lamenting about how the housing market is crashing or impossible. What is the definitive thesis they should deliver based on this data?
The thesis is that Tarrant County in late May 2026 is fundamentally a stable, moderately competitive, heavily bifurcated market. The foundation still belongs to the seller. We have 3.5 months of supply, which is a structural advantage. However, the frenzy is dead.
The blind bidding wars are over.
Right. Buyers have 48 days of breathing room to make rational, calculated decisions.
And the pricing reality depends entirely on your tax bracket. If you are operating in the $350K median middle, you are in a flat, affordability-constrained environment. Expect stability, not bidding wars. If you are at the $600K plus top, properties are appreciating rapidly because cash is insulating those buyers from 6% rates.
And if you want to build a custom home on raw land, you have 15 months of oversupply and can dictate your terms.
Most importantly, remind them of the financing strategy. Do not fall into the waiting game fallacy. Do not wait for the Federal Reserve to cut rates and inadvertently trigger a massive spike in home prices. Use the current market stability to your advantage.
Find the house at a flat price today. Negotiate heavily on seller concessions, and use their equity to buy down your interest rate permanently.
You manufacture your own market conditions. You now have the actual facts, the hard math, and the underlying mechanisms behind the clickbait headlines. You know exactly how the engine of Tarrant County is running.
Before we wrap, I want to leave the listener with one final, broader economic concept to mull over.
Let's hear it.
We spent a lot of time dissecting the psychology of the buyer, waiting on the sidelines for the perfect moment, waiting for late 2026, waiting for rates to drop, waiting for the news to tell them it's safe. But if you look at the last 100 years of real estate, the greatest transfers of generational wealth, the most significant accumulations of equity, rarely happen during the chaotic, headline-grabbing peaks or the terrifying valleys.
When do they happen?
The real wealth is quietly acquired during periods of boring stability. Periods exactly like the one Tarrant County's median market is experiencing right this second.
The quiet accumulation of assets while everyone else is distracted by the noise.
Exactly. When the market is flat, when days on market are expanding, when sellers are willing to negotiate concessions, that is when the savvy investor or buyer strikes. If you sit back and wait for the mainstream financial headlines to finally announce that it's officially a good time to buy, are you already too late?
Wow. That is a phenomenal, slightly terrifying question to leave hanging in the air.
Well,
If you wait for the dashboard to flash the green light, the highway is already going to be packed with traffic. Thank you so much for joining us on this deep dive. Take these localized numbers, apply these strategies to your own ZIP code, and most importantly, stay relentlessly curious about the data. We'll see you next time.